Let's start with an uncomfortable premise. If gold is repriced to $50,000 per ounce, silver at its price of $80 per ounce today isn't cheap, it's just mathematically wrong. Not undervalued, not lagging, just wrong. And wrong prices don't survive regime changes. Silver does not reset monetary systems. Gold does. Silver inherits the reset. That's how it's always worked. Gold anchors credibility. Silver transmits pressure. So if gold reprices, silver doesn't get to negotiate. It has to reconcile. For most of recorded monetary history, the gold to silver ratio lives somewhere between 10 to 1 and 20 to 1. Let's split the difference and call it 15 to 1. Not because of superstition, but because the relative scarcity and monetary usage. Even in periods of stress, the ratio rarely stayed above 30 to 1 for long. Today, even with silver near $80 and gold north of $5,000, the ratio is still extreme. Now insert $50,000 gold into the equation. Let's do nothing fancy, no speculation, no industrial arguments, just ratios. Let's even tamp that down a little bit. Say gold's only $45,000. At 30 to 1, silver is $1,500. At 20 to 1, silver is $2,250 per ounce. And at 15 to 1, silver is around the $3,000 per ounce that it should be. Even at an abnormally suppressed ratio, silver is not triple digits today. It should be 4 digits. Ratios don't stay wide when systems reset, they compress. Why? Because gold becomes immobilized. Central banks stop selling. Gold exits the market. Liquidity disappears. Silver, meanwhile, remains tradable, industrially necessary, and privately held. That combination forces convergence, not gradually, but violently. Now, here's where things get unstable. The entire investable silver market is tiny, roughly $200 billion in today's prices. Even at $1,500 per ounce silver, it's still smaller than a single mega cap stock, a few days of bond issuance, a rounding error in the FX markets. Silver cannot absorb post-reset capital flows calmly. It gaps. Unlike gold, silver is not optional. Over half of silver demanded is industrial, power electronics, solar, defense, medical, data infrastructure, and so on. Even at $1,000 an ounce silver, demand does not vanish. It reprices into finished goods. Consumers never see a line item, they just see higher output costs, which means prices does not cure scarcity quickly, it reveals it. Silver never stops at fair value, it overshoots. And why? Because the paper market is massively leveraged. When confidence breaks, paper claims scramble for metal. Delivery pressure explodes. Futures cease to set price. And that's when silver trades where it clears, not where it gets quoted. And we're probably going to be seeing that in March. If gold stabilizes around $45,000 to $50,000 per ounce, the realistic silver range is a minimum reconciliation of about $1,500 per ounce, a likely range of about $3,000 per ounce, and potentially higher if industrial bottlenecks persist. That's not bullish, that's just math plus history. Because silver repricing is messy. Gold can be revalued quietly on balance sheets, but silver reprices publicly in futures markets, in industrial supply chains, in visible shortages. Silver forces honesty, and honesty is disruptive. If gold is repriced to $50,000, silver at $80 isn't early, silver at $300 isn't aggressive, and silver at $1,000 isn't crazy. Silver below 4 figures means the reset isn't real. Gold resets trust. Silver proves whether the reset worked. And the math says this: You don't get $50,000 gold without $3,000 silver in the same monetary system. One of those prices has to move. Thank you for watching all the way to the end. As always, please take care of yourself and each other. And as always, build that stack.